What up, investors? Ken here from the Dyslexic Investor, and we are looking at a reaction video from our good friend, our good YouTuber, Jeremy, which is the Financial Education channel. I have his video here. We're going to be analyzing it slightly. This is the 3 dividend stocks that he is buying in February 2020. And if you watched the whole video, which I have before, and don't forget to slam that like button, that he is analyzing some stocks that he's buying into and getting, and he's saying as a value just for its dividend play. So that being said, we're going to analyze it more on the technical side. Yes, fundamentals are somewhat important for dividend stocks and so forth, but I think there's other options out there for dividend and also growth stocks. So we're going to be doing the first part of the video of analyzing his 3 picks, and then we're going to be throwing my 3 picks as well as 3 different stocks that I would like to purchase and already currently have. Alright, the 3 stocks that he suggested is Walgreens, Boots Alliance, then he's going to be recommending Carnival Corporation, which is the cruise line, and then Foot Locker. And then we're going to be looking at those technically via the charts, and then we're going to be giving 3 suggestions of the 3 dividend stocks that I have, or 2 of them, and 1 that I'll be potentially adding as well in February on any pullback. So stay tuned and see if any of our great stocks match together. Alright, so the very first one that Jeremy mentions in his video is Foot Locker, which is ticker symbol FL here. Currently trading at $38.60 of last Friday's close. So this is, again, the Foot Locker, the store where you go and buy shoes. They acquired some other companies for resale stuff. You see their overall 52-week range is pretty high, was at 68 basically last year. We're going to be looking at more in depth on the chart. Market value at $4 billion with a B. We're going to see the overall fair value is in the middle. You kind of give the Yahoo shenanigans what they're looking at here. That being said, let's go look at the chart here. We're going to pull up Thinkorswim. Alright, here's Foot Locker. This is on a yearly daily chart. So currently you see the price closed right over here. We're seeing the trading range pretty tight, staying below the 200 since basically May of last year. That being said, there's a lot of competition for a lot of these shoemakers. Why would Nike want to sell their shoes at a Foot Locker if they have such an online presence and things like that? And then everyone knows that Amazon's taking over everything, killing 35% of businesses in the mall. And this is very much a mall business. But again, in this video, he's saying that he wants to buy this at a much lower level. He would want to back up the truck around $35. So this is basically, I have my initial target at 36, and it can easily come back down to the 33 level, depending on how everything goes. They had a recent quarter, didn't do very well, not too much upside, still trading below the 200, which is never a good sign. A lot of the moving averages are pointing down even more. They have to build a better base. So let's go ahead and look at a much longer time frame. This is a weekly chart. So this is 3 years and each bar is 1 week. You kind of see the trend here. It's having a tough time getting above even the 200 moving average on the weekly, which is around $58, and then trading as low as 28 basically in November of 17, and just kind of been trading sideways. And that being said, I think this is a lot to do with just people not going to the Foot Locker to buy things. It's not the norm anymore. The trend is no longer really going to the mall to buy shoes. The overall, I want to show the standard deviations here. Let's go to this chart. It's trading in the middle of the line here, which is it's fine. So you can see most of the times the big moves are, of course, at earnings. You see these ginormous volume boosts here. Not sure what happened there. They pay a pretty standard dividend. I think the dividend was I don't see it on here. Alright, so we actually found it here on the much more accurate site. What the dividend is 3.94, so basically I was right, 4%. A lot of insiders don't, that means a lot of people don't really own it. Industry owned, not really well known. Short float is at almost 9%, meaning all the outstanding shares, 9% of them are short. They have earnings coming up. They're below their 50, below their 20, below their 200. You can kind of see here. Recently got a downgrade from 47 to 41. These are not really good inline estimates. So that being said, I would not be purchasing Foot Locker, even though if it drops to $33, it could be a nice swing trade higher. It's just not a great dividend stock because it's the trend of a dividend stock. You want to hold it for a long period of time to be able to collect that dividend. But a 4% dividend for a stock that's probably going to be losing money and a lot of headwinds with technology of Nike, Lululemon just dominating the online markets, and Amazon and all those other guys just dominating as well. Like, this is something I would not like to be in. So jumping to the very next recommendation that Jeremy did, we're going to be jumping into Carnival Cruise Line. So we're just CCL. That's the ticker symbol for you guys. CCL ticker symbol. Again, this is kind of the same thing too. It's slightly below its 200. It is starting to make a reversal. It's not as good performing as other cruise line companies in the industry. The dividend is a little bit higher at 4.21%. So the shares are around 50 bucks. They're getting 4% of that back. 4 times a year dividend. That's not bad at all, right? But that being said, we have a lot of this is much more owned across the board. So this is a much better play on my standing of what I would look at. It's not as negatively bounced. Like the cruise line business is pretty much like a moat. It's very difficult to get into this business. What Warren Buffett always said. And that being said, let's go ahead and look at the chart. So again, it's CCL. Bada bing, bada bang. Here we go. Again, this is probably due to a lot of the coronavirus breaking out in China and now spreading into France, and I believe in the UK now too as well, and Australia, of people getting affected with this strain of the really contagious flu. So a lot of this is affecting the travel industry, anything to do with traveling, transportation, anything to do with fun and being around a lot of people. So that being said, it is broke below its 200-day today, pretty straight down. I think that this could come down substantially, quite some bit more, but this would be something that I would like to add to my list. Looking at a much longer time frame of a weekly chart, you kind of see here that it's been having a little trouble on a downtrend, so we can just draw these little lines here. This is a downtrend. If you've ever seen it, it needs to kind of break past this. We're going to just kind of call it like this. It might be better if I just give you this chart, and we're going to go on a weekly. So it's kind of breaking off of this. It needs to break above this line here, which this little downpull has not done any favors for us in that sense, but this is definitely something I want to be looking at. If the 21 exponential moving average on the weekly chart can hold, because it has kind of created a base down here and started to move higher, having a really great quarter here on 12/20, on probably seeing a high revenue with a lot of people want to take a travel over the colder months. They want to take a nice tropical cruise. They got you covered. But then having a little bit of a pullback, if it can hold a 21, like maybe hold a starter position coming into Monday. But the thing to watch for this is very much the news, in the sense of how the overall outbreak is being contained, what's going on, because you've seen here, like this thing can move down, and majority of the time it's due to earnings or anything else going on in the world. Again, pretty nice payout. Would like to own this, but that being said, it needs to this whole coronavirus needs to come out. So this is a really good pick from Jeremy. I like that he's saying that he wants to load up the boat as well at a little bit lower level. I like to see about like this level to hold here potentially. Again, I would be looking more on a weekly chart because this is a dividend stock, so I want to look more of the long term. But that being said, that is definitely a great pick from him. Then last but not least, we're gonna do Walgreens, not Wells Fargo. So it's WBA, and this thing has been through the ringer, has been beat up quite a bit here. Having dividend of 3.52%, breaking out of its trend tunnel here, trend channel, well below its 200 by 5%, well below its 50, well below its 20. Insiders own this not as much as Carnival, but the overall ownage of this stock is not as great as the short float, which is good. But that being said, let's go ahead and look at the chart. So that's WBA, Walgreens. There we go. And this is kind of like the same scenario here. Like I have my markers here and here. I for sure see this breaking down to at least the $50 level, which Jeremy said that that's where he would like to see this better. So he wants to see this kind of rebound over here to get to the $50 level again, and for a potential nibble, get a starter position. But again, even on the weekly chart, you're below the 200. That's never a good technical analysis. On the daily chart, we have just broken from its last earnings, just down. This is a falling knife you don't really want to catch, because you can see here in the last quarter, it literally fell for nearly 2 months before it bottomed. This can easily fall for another 2 months before it bottomed, technically speaking. On the flip side, this could be a potential. A lot of the rumors were up here at this level up here, around the $70 level, was that they're going private. But this company is so ginormous that I think it's a $46 billion market cap. So that's a huge company. So if they wanted to take it private, we're looking at probably $100 billion. That seems crazy, right? $100 billion, that's a lot of money to take a company private. And I don't know many equity firms that can swing that. Probably even more than that on its market value, because it's just everywhere. But that being said, like, I wouldn't want to be buying this. I would need to see how it ends at 50. So I like Jeremy's looking at the overall stock and being very patient and showing that he wants to wait until it hits the $50 level before he really wants to back up the truck. On the flip side of this, I like CVS though, because CVS is a little bit more diversified, and you get a dividend. It's above the 200, which is great. Again, it just went down due to a lot of the health scares. Again, the market overall went down on Friday, but this might be a great upward buying opportunity. We're going to be creating some live alerts here. We're going to do at or below here, and I want to see if it breaks out above this. If so, this might be a great add as well. This stock's a little bit more pricey, so it's looking at $70. This thing has been beaten up in the past, but it has been a great runner. So I wanted to show you this here. So we're going to go to CVS. They have a little bit lower dividend at 2.8, but you have growth behind it. It's above its 200, okay? Just slightly, it just closed below its 50-day. It's much more owned by industry and by institutional buyers. The short float is non-existent basically, and it just got a couple outperform and buy ratings from Deutsche Bank and RBC Capital Markets, and Standpoint Research from a buy to hold to buy. So this is really good news behind it. It is kind of breaking down slightly, technically speaking. Let's just look at this at a longer time frame. And again, it's coming down to that 21 exponential moving average on the weekly. They have a dividend payout on, oh, they had a dividend payout this week at 50 cents for a $70 stock. This is about a little bit less than half than what you would get for the dividends, but you're getting growth behind this. So this could potentially grow X amount moving forward. Again, we're just barely below the 200 on the weekly chart. We just closed below it. We were above it, but the potential for this to go higher on top of it paying you a dividend is a really great incentivized thing. Another stock that I like, that I actually own for our portfolio, is T, or also known as AT&T, and this pays out at 5.4%. And this is not as heavily held by a lot of investors. The short float, again, is non-existent. It's above its 200, above its 50, but it's been kind of closing there and there. You saw a lot of downgrades from HSBC, these guys, and Standard Point Research. That was in November. So usually if one guy goes, like 3 or 4 follow. You can kind of see that trend here. So that was in November of 18. And guess what happened? Like, it got hit, recovered, and then continued to trade sideways. So if this thing just trades sideways, you're getting a 5%, little over 5% dividend on this. On a weekly chart, this looks beautiful. Looking at coming into earnings, so AT&T, they own everything. They own HBO, they own the cell towers, the cell network, internet services, DirecTV, all this good jazz. I have an alert going out here, which I might need to add this a little bit lower because I want to get more aggressive on this to buy some more. That was initial here at the 200 on the weekly. But that being said, this is a fantastic looking chart. Just trading sideways a little bit with the market, but once I think people see that the value behind T is going to be really great. Like to see this come down to maybe not test this level, but maybe test the 89, because it's a little consolidating here. When the 8 crosses over the 21, we could get some the selling, which we did, but now the 8's trying to come back up into the 21 and kick higher, like what happened here and happened here, where you can kind of get like a V-shaped bottom. Like, this is a V-shaped bottom, that's a V-shaped bottom, that's a V-shaped bottom, V-shaped bottom, a U-ish bottom, another U-ish bottom, but this thing just kind of just continues just to tread higher, and I like this very much, very much, very much so. So those are kind of like my analysis on the video from Jeremy and so forth, on looking at what he was trading and looking at buying, and then what I would consider buying. I like Carnival Cruise, I like AT&T, and I like CVS of my list of 3 dividend stocks, because I own AT&T already. I don't own CVS, but Carnival Cruise, I took a little nibbler due to the overall scare of the health outbreak. So that being said, thank you guys so much for watching. Don't forget to put the link to Jeremy's video down below as well to support his channel, and don't forget to, if you don't mind, hitting the like button on my channel, and also hit subscribe if you haven't already. Thank you guys so much for watching. This is Ken from the Dyslexic Investor. I'll catch you guys on the flip side. Peace.